Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know: first, oil prices risk surging past $100 as Hormuz shutdown triggers an OPEC Plus emergency meeting, but limited spare capacity threatens a global stagflationary shock. So we'll discuss why the OPEC Plus production hike may be a paper promise and what it means for the Fed's fight against stagflation. Second, the dollar's share of global reserves plunges to a 57% two-decade low as central banks flee weaponized finance, threatening America's exorbitant privilege. We'll explore how this global rebellion against the dollar is eroding its convenience yield and could structurally increase US government borrowing costs. Third, South Korea's semiconductor exports surge 160.9% on an AI supercycle, but the boom faces a major threat from potential US tariffs. Today, we'll take a closer look at this conflict between a historic tech boom and US trade policy and its implications for global inflation. Analysts are now warning that oil prices could rocket past $100 a barrel. The reason? The world's most important oil route, the Strait of Hormuz, has effectively shut down. Shipments carrying over 20% of the entire world's oil transit have come to a halt amid rising conflict in the Middle East, sending oil prices jumping to their highest level since July. As we noted a while back, this isn't theoretical. Major shippers have paused sailings, tankers have piled up near Fujairah, and Iran's Revolutionary Guards have been broadcasting no shippers allowed to pass. Reuters now pegs prices around $73 a barrel. And the impact here goes far beyond the gas pump. The jump in oil prices isn't just a temporary reaction, it reflects a fundamental repricing of geopolitical risk. For years, markets may have underestimated the danger of a real sustained closure of the Strait of Hormuz. What's happening now is that risk premium is finally being paid. A sustained shutdown would force a complete rerouting of global energy flows, spike shipping and insurance costs, and severely impact inflation, especially in energy importing economies. And remember, for Europe, after pivoting to Qatari LNG, a closure here also crimps gas flows, not just oil. This is a critical test for the energy security of many nations. For a major oil importer like China, a prolonged disruption in the Strait of Hormuz is a serious challenge. As we mentioned a while back, nearly a third of China's crude imports typically pass through this choke point. This situation will likely accelerate its strategic pivot toward more secure overland supply routes, such as pipelines from Russia and Central Asia. This would reduce Beijing's reliance on maritime shipping lanes that are vulnerable to geopolitical conflicts and naval power, cementing a new energy axis and reshaping the world's long-term energy map. A few days ago, we walked through the shipping standstill. Today, there's another important update. In an emergency response, OPEC Plus is now considering a massive oil output increase. Sources say the group will debate a production hike of 411,000 barrels per day or even more. To put that in perspective, that's a huge surge from the 137,000 barrels per day originally considered. But that's not the whole picture. The real turning point is that this emergency plan faces a critical problem, a lack of actual production capabilities. So the thing is, there's this concept of spare capacity. In the oil market, this refers to the volume of production that can be brought online within 90 days and sustained. It's the world's emergency buffer. While the group can announce a major hike, the power to meaningfully add to supply rests almost exclusively with just two nations, Saudi Arabia and the United Arab Emirates. The rest of the alliance has very little spare capacity to pump more oil, even if they wanted to. This creates a dramatic power struggle. The market is desperate for stability, but the proposed solution may be a paper promise. We have a potential supply disruption that could send prices soaring, met by an emergency production plan that may not have the firepower to back it up. So what happens next? If oil prices do stay near $100, this would act as a major stagflationary shock to the global economy. As we warned a while back, a jump in oil acts like a tax on consumers, slowing growth while pushing inflation higher. Stagflation is a central banker's worst nightmare, a combination of stagnant economic growth and high inflation. This could force central banks like the US Federal Reserve to abandon their plans for rate cuts, threatening the soft landing narrative that has been supporting stock markets. They would face a painful choice: fight inflation with higher rates and risk a recession, or support growth and let prices run high. With OPEC Plus capacity so tight, the world's other major lever is the US Strategic Petroleum Reserve, or SPR. But here's the dilemma. After a massive release in recent years, the SPR is already at multi-decade lows. As we noted before, that makes it a blunter tool than in past crises. Using it now would mean choosing between curbing short-term gasoline prices and preserving long-term energy security, significantly weakening US leverage in any future crisis. The world is now caught between OPEC's pledge to stabilise the market and the physical reality that most of its members may be unable to deliver, leaving global energy security hanging in the balance. Speaking of geopolitical risks sending shockwaves through the global economy, another fundamental shift is underway, this time in the world of currency. It seems central banks around the world are quietly staging a rebellion against the US dollar. The dollar's share of global foreign currency reserves has plummeted from 71% down to just 57%. Now, this isn't just a statistical curiosity. The latest data from the International Monetary Fund, or IMF, confirms this trend, showing the dollar's share of global reserves has hit its lowest level in over 2 decades. Interestingly enough, this data is what experts call a lagging indicator. This means it reflects decisions that central banks have already made, confirming that this shift is not just a temporary blip, but a deliberate long-term strategic move. It's a powerful signal of declining geopolitical trust in the US-led financial system. This isn't a random market fluctuation. It's a direct response to what experts are calling weaponized interdependence. The increasing use of the US financial system as a geopolitical weapon is forcing allies and rivals alike to build an escape hatch. To really grasp what's at stake, you have to understand a concept called exorbitant privilege. For decades, because the dollar was the world's primary reserve currency, the US enjoyed the unique benefit of being able to borrow money more cheaply and run large trade deficits. However, by using financial sanctions as a tool of statecraft, the US is essentially raising the political risk for other countries to hold dollars. This forces them to question the safety of their dollar assets and in turn erodes the very privilege that underpins American economic power. As former central bank governor Mark Carney warned, major powers are now using financial infrastructure as a tool of coercion. That threat has triggered a global race to build alternatives. And believe it or not, these alternatives are no longer just theoretical. Take China's cross-border interbank payment system known as SIPS. This is a leading indicator of a new multipolar currency system. As of last year, SIPS has already connected over 4,900 financial institutions across nearly 190 countries. While it still relies on the SWIFT messaging system for some transactions, its rapid growth shows a clear intent to create a viable channel for trade and finance outside of the dollar's orbit. For Chinese businesses and their trading partners, it means the potential to settle transactions directly in renminbi, reducing currency exchange costs and exposure to US sanctions. You can think of this as a global campaign of self-insuring against American financial dominance. Each new digital yuan, each new European repo line is another brick in a wall being built around the dollar system. This trend is already having an impact. The trade-weighted dollar has lost 7% of its value over the past year, but the real danger is the long-term cost. This brings us to a crucial factor, something called the convenience yield. This is essentially the premium investors are willing to pay for the safety and liquidity of US Treasury bonds. It's like a discount the US gets on its borrowing, but recent US Treasury auctions have shown weaker demand with lower bid-to-cover ratios. The bottom line is that US borrowing costs could rise structurally, independent of any decisions made by the Federal Reserve. As that privilege erodes, the cost to service America's massive debt pile, on course to hit a staggering 130% of GDP in 5 years, could become dangerously expensive. The era of unquestioned dollar dominance is facing its most significant challenge yet. In the short term, this de-dollarization trend could mean more volatility in currency markets and sustained upward pressure on US interest rates, impacting everything from corporate bonds to home mortgages. For investors, this changes the risk calculation for assets that were once considered unconditionally safe. Key things to watch will be the IMF's quarterly reserve data, the demand metrics from upcoming US Treasury auctions, and the transaction volumes on alternative platforms like SIPS. These are the real-time indicators that will show us how quickly this new financial world is taking shape. Disclaimer, this report is for informational purposes only and does not constitute financial or investment advice. Market conditions are volatile and subject to change. While the foundations of the global financial system are shifting, some sectors of the economy are experiencing an outright explosion. Let's pivot to the world of technology. Let's start with a single statistic that might just change your entire perspective on the tech industry. Semiconductor exports from South Korea just skyrocketed a jaw-dropping 160.9%. That single number is fueling a massive export boom for Asia's fourth largest economy. For the 9th consecutive month, exports have surged, hitting $67.45 billion in February and crushing analysts' forecasts. The engine behind this explosive growth is the global race for artificial intelligence. Now, get this. Experts believe we are witnessing the start of a new AI supercycle. The crucial difference this time, unlike previous cycles driven by smartphones, this one is fueled by massive concentrated investment in AI infrastructure. This suggests the recovery in the global tech sector could be more durable, even if it's narrower. To put it in perspective, the price for a key type of memory chip, the 16GB DDR5, has exploded from around $3.79 a year ago to nearly $30 today. That's the kind of demand we're talking about. However, there's a fascinating divergence happening. While exports are roaring ahead, South Korea's import growth is much weaker. This divergence might signal a global economy where specific sectors like AI are booming, but broader consumer and industrial demand is still sluggish. This creates a real puzzle for central banks trying to gauge the true health of the economy. According to South Korea's trade ministry, relentless demand from AI investment and a surge in memory chip prices pushed semiconductor sales over the $20 billion mark for the third straight month, marking the highest monthly performance ever recorded. Here's where it gets interesting for the broader economy. This surge in memory prices could be a turning point for global goods inflation after a year of declines. A sharp rebound in the price of these critical electronic components could complicate the last mile of the inflation fight for central banks like the Fed, potentially delaying expected interest rate cuts. This makes the country a key bellwether for global trade, signaling intense demand across the entire tech sector. For our audience in China, this data holds another layer of meaning. By analysing where these high-end chips are going, we can get a clearer picture of China's own domestic tech demand. A sustained rise in South Korean semiconductor sales to China would indicate that the nation is successfully building its own AI ecosystem, despite external controls. This is a crucial economic signal about the effectiveness of various technology-related policies and the progress towards self-sufficiency. However, while the chip industry celebrates these record-breaking figures, a major storm cloud is gathering on the horizon. The entire outlook is now shadowed by significant uncertainties surrounding US tariffs. This is significant because it signals a potential new phase of US trade policy, one that could target not just rivals, but key technology allies as well. This could force a major strategic rethink for partners like South Korea, potentially disrupting the very semiconductor supply chains the world relies on and creating new price volatility, especially if it gets linked to compliance with policies like the CHIPS Act. This creates a core conflict. A nation experiencing an unprecedented economic surge is simultaneously facing geopolitical pressures that could disrupt the very foundation of its success. The numbers paint a picture of a historic boom, but the looming threat of tariffs means one of the world's most critical technology suppliers is navigating a period of both record-breaking prosperity and profound economic risk. Looking ahead, the key things to watch are whether the demand for high bandwidth memory, or HBM, continues to grow, and whether AI server shipments keep rising. These are the real-time indicators of this AI supercycle. This will likely keep stocks of AI-related hardware companies in the spotlight. At the same time, the strong trade surplus could put upward pressure on the South Korean won. Finally, keep an eye on statements from the Bank of Korea and the US Federal Reserve, as they will be the first to signal how this tech boom is affecting their plans for inflation and interest rates.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.